Whoa, take a look at that number. Over 25,000 crore rupees. That's literally the projected fiscal year 26 revenue for a regional powerhouse that's basically been quietly building an absolute empire down in South India. Look, whether you're an investor closely watching the markets or a retail executive hunting for explosive real-world growth strategies, you simply can't afford to ignore this giant as they prepare to hit the public markets. Okay, let's dive into this. Welcome to this explainer covering the highly anticipated 1,700 crore rupee Lalitha Jewellery IPO. We're going to lift the hood and unpack exactly what makes this company tick, crunch their financial numbers, and take a completely objective look at the hard facts surrounding this massive market event. Here's our roadmap for today. First, the IPO details. Second, we'll go inside the business model. Third, financial growth and margins. Fourth, key strengths and risks. And finally, the valuation and our final verdict. Number 1, the IPO details. Let's get right into it. All right, so the total issue size is a really hefty 1,700 crore rupees. But notice the makeup here. A significant 1,200 crores of that is a fresh issue. That means the capital goes directly into the company to fund growth. The remaining 500 crores, that's an offer for sale from existing promoters. Now, the price band is sitting between 190 and 201 rupees per share. And since the lot size is 74 shares, retail investors can get in for a minimum of 14,874 rupees. Now, timing is absolutely everything here, and the window is incredibly tight. The issue opens on August 17th, 2026, and closes just 2 days later on the 19th. The basis of allotment gets finalized right away on the 20th, then refunds and share credits roll out on the 21st, and the big day, the actual listing on the BSE and NSE, is scheduled for August 24th. So definitely mark these dates on your calendar if this is on your radar. So how are all these shares actually being sliced up? Well, half of the net issue, up to 50%, is reserved for qualified institutional buyers, the heavy hitters. Retail investors like us get a pretty healthy 35% allocation, and the remaining 15% is set aside for non-institutional or high-net-worth individuals. Oh, and it's definitely worth noting there's a dedicated employee reservation of up to 6 crore rupees, which comes with a really nice 19 rupee per share discount. Now, where exactly is that fresh capital going? This is absolutely crucial for any executives out there trying to understand their expansion playbook. Roughly 1,033 crores is being aggressively deployed just to open 10 new showrooms. We're talking massive gold inventory, physical store fit-outs, and the IT infrastructure you need to actually scale those operations smoothly. Section 2, inside the business model. Now, what's really interesting about this slide is Lalitha's core strategy. It is fascinating, especially if you're a retail executive analyzing market penetration and explosive growth. They run a relentless, high-volume, low-margin model. So instead of chasing those extreme luxury markups, they specifically target middle-class consumers through a pure value price positioning. They offer lower wastage and making charges while totally guaranteeing purity. It is a volume game, pure and simple. And they execute this volume game through a really massive physical footprint. They operate 61 stores, but here is the strategic masterstroke. 74% of those are intentionally placed in Tier 2 and Tier 3 cities to capture all that untapped wealth. We are talking about massive showrooms, over 5,000 square feet, completely supported by 2 in-house manufacturing units down in Tamil Nadu that gives them ruthless control over their direct costs. But honestly, here is their real secret weapon. It's a total masterclass in working capital called the Dhana Vandhanam scheme. Basically, it's a customer advance program that generates massive, interest-free deposits because customers are paying now to buy gold later. This gives Lalitha a zero-cost capital float that's projected to reach a staggering 5,042 crore rupees by FY26. It's a brilliant moat, and it drastically reduces their need to rely on expensive bank debt. Section 3, financial growth and margins. Let's see how that zero-cost moat actually translates into hard numbers. Looking at the projections from FY24 to FY26, total revenue is expected to surge from roughly 16,800 crores to over 25,000 crores. But really look at the efficiency down at the bottom line. Net profit is projected to nearly triple. That pushes their return on equity from around 18% to a massive 41.6%. Plus, thanks to all that customer-funded capital, their debt-to-equity ratio is actually shrinking as they grow. That's rare. And because of this relentless high-volume model, their store-level economics are just incredible. They're projecting an industry-leading productivity of over 410 crore rupees in revenue per individual store by FY26. When retail executives and institutional investors compare that totally unmatched revenue density to their listed peers, well, it becomes pretty clear why this IPO is generating so much heat. Section 4. Key strengths and risks. So the crucial point is we need to impartially weigh the reality of their operations. On one side, you have incredibly powerful growth drivers, fresh funds to launch 10 new stores, that massive 5,000 crore zero-cost capital moat, and a broader consumer shift toward trusted, organized brands. But on the other side, the structural headwinds are stark. They face severe gold price sensitivity with zero formal derivative hedging. Furthermore, 100% of their revenue is entirely concentrated in South India. It is your classic high-reward, high-concentration scenario.
Section 5. Valuation and final verdict.
Now, looking at the near term, the gray market premium is currently hovering between 28 and 32 rupees per share. Against that upper issue price of 201, that implies an estimated listing gain of roughly 14 to 16%. This short-term optimism is largely being driven by strong anchor investor interest, which provides a perceived downside cushion right out of the gate. But we have to remember, gray market action is really just short-term noise. To really understand that downside cushion, we just have to look at the valuation cap. Based on post-issue projections, Lalitha's price-to-earnings ratio sits at roughly 11.1x. Now, compare that to the peer average. Companies like Callian and Senco are trading at a PE of over 25x. That is a massive, highly tangible discount relative to the rest of the organized jewelry sector. So, based on the source data, the objective long-term verdict suggests that Lalitha Jewellery serves as a really attractive compounding candidate for investors who focus heavily on value and growth and who can actually tolerate the cyclical nature of unhedged gold prices. The fundamentals here, driven by super fast inventory turnover and those massive advanced collections, they make a very strong case.
But it all comes down to your personal strategy. You've seen the masterful zero-cost capital float, but you've also seen the undeniable risks of having 100% geographical concentration without any formal gold hedging. So, as you stare at that 11.1x PE ratio, you have to ask yourself, does this deep valuation discount truly outweigh the heavy regional risk? It's a fascinating setup to watch. Thank you so much for joining us on this explainer.